It's that time again, guys, to talk about my three largest stocks in November 2018. Let's get started. What's up, everybody? My name is Ale, and welcome to my world of stocks. If you're new to this series, this is where I talk about my three largest stocks and I give a monthly update on how they're doing so far and how I feel about them going forward. But I also have another monthly series called 3 Stocks to Buy, and that's where I talk about other stocks that I think are worth looking at that have a lot of long-term potential. And they're not necessarily stocks that I'm invested in, not always, but it's just kind of a way of giving you guys some diversity and looking at some other stocks instead of just stocks that I'm invested in, which might get a little boring. But it's all a lot of fun. And if you want to check out past episodes of either series, I created playlists for both in the description, and you can also find them on a clickable card at the end of this video. But currently, my three largest stocks are still Disney at number 1, Microsoft at number 2, and Nintendo at number 3. And I know that you guys really like timestamps, so I created some timestamps for you in the comment section in case you want to jump to a specific part of the video or a specific stock. And speaking of which, make sure you leave me a comment. Let me know how you feel about these stocks and let me know which stocks you're invested in. I always love reading those comments and hearing what you guys think. But with all that being said, let's go ahead and start with my number 1 largest stock, that being Disney, ticker symbol DIS. Okay, now we're going to get into all the reasons why I'm bullish on Disney in the long term. But first, we'll take a look at their recent performance. But actually, before we do that, we should talk a little bit about the market's condition right now because it is volatile and it's kind of all over the place. And a lot of people feel that this is really the start of a market crash. Now, I'm not necessarily on that boat. I do think that we're going to rally up a lot more once all of this short-term noise goes away. But a lot of people feel that this is the start of a major crash. So just keep that in mind. Make sure you do your own research and make your own decisions and be very cautious out there because the market is pretty volatile. Having said that, with so many stocks being absolutely hammered right now, so many stocks are just dropping like flies right now, Disney actually hasn't performed too bad. In the past 6 months, we're still up around 15%, and we're up almost 5% in September. And then when looking at this past month of October, where many stocks have been taking a complete nosedive, Disney only dropped by around 3% so far, and it still trades at around $113 per share. Now, that isn't to say that Disney won't drop more in the short term. I think that a lot of this market volatility will continue for a while. I don't really see the whole trade tensions with China being solved anytime soon. Midterms still have some time until we kind of get through them. And we also have the worry of rising interest rates. So a lot of this short-term volatility may actually still last a little while. Now, historically, when Disney drops below $100, that's when I really bought like huge amounts of Disney. So if Disney drops below $100 again, I would be freaking ecstatic and I would probably just pick up so many shares of Disney. But even at less than $110 per share, I think wouldn't necessarily be too expensive for Disney, in my opinion. Now, why do I think that? Well, in a market where everyone seems to be making blanket statements saying that stocks are just completely overvalued, I don't think that Disney is actually that expensive. When looking at the S&P 500, they currently have a PE ratio of around 22 on average for their stocks, and Disney is actually much lower than that at only around 14. And even looking at what will soon be one of their biggest rivals in Netflix, their PE ratio is massively higher at over 100. And last year, Disney had an operating margin of 25%, while the S&P 500 was only at around 11%. But that's just the valuation. Let's take a look at some of the different reasons why I'm invested in Disney. Now, they obviously play a major role in my dividend growth portfolio. They have about a 1.5% yield, pretty low payout ratio, and almost a decade of growth. But when talking about the business, they of course have massive resorts and theme parks like Disneyland and Disney World, which, by the way, the annual price for Disney World was actually increased by another 15% this year as they prepare to launch their Star Wars expansion next year. But they also have some of the biggest brands in the world like Star Wars, Marvel, all the Disney kids stuff like Mickey Mouse, Frozen, all the Pixar stuff. They also own ESPN, ABC. They have their newest acquisition of 21st Century Fox assets, where they also gain control of X-Men, Deadpool, The Simpsons, Avatar, Family Guy, and the list just goes on and on. Now, that was obviously a move to strengthen their available offerings as they get ready to launch their newest streaming service next year that is set to compete with the likes of Netflix. Now, there's three primary takeaways I have from that newest venture. One is that it's arguably one of the smartest decisions that Disney could have made. I think one of the reasons why Disney stock is still trading relatively cheap is because they're coming off of years and years of disappointment from customers continuing to cut the cord, right? The whole movement of cutting your cable or canceling your cable subscription, which means lower viewership numbers and lower subscriber numbers for their cable properties, especially ESPN. So because Disney has been on the losing side of the whole cable TV versus online streaming battle, this has really taken a toll on their revenues. In fact, Disney will be reporting their fiscal fourth quarter earnings very soon. I think it's on November 8th. And the interesting thing is that Disney has actually reported decreased revenue in that quarter for the past 2 years. Now, this time around, it is expected to be much better. Wall Street is expecting revenue growth of over 7% and earnings growth of around 24% as Disney continues to improve their business. But those might not be very easy targets to hit. Now, if they do hit those targets, I think the stock will continue to perform better and better, and with all the hype building up of their streaming service, we could really start to see a rally. But if they miss those targets, I think we could definitely see this stock take a pretty significant dip. Long term though, I think the story is all about Disney adapting to a changing market by making all the right moves. After reporting viewership numbers that were very disappointing from ESPN for the last few years, their transition to ESPN Plus, which is their online streaming version of the network, is already gaining a lot of attention and traffic. In fact, the service only launched recently, I think back in April, offering live sports, original shows, movies, and on-demand library, but it already has over 1 million paid subscribers, and investors will be paying close attention to it as it's expected to grow substantial revenues for Disney in the long term. On top of that, their recent acquisition of Fox assets gave them majority control of Hulu, and despite what people often say about Hulu, it's actually not performing that bad. They've already reached over 20 million subscribers, which is a very significant number. But of course, all eyes will be on Disney's newest streaming service launching next year that is really set up to be a competitor to something like Netflix. Now, this will essentially wrap up their entire package of online streaming. You've got ESPN Plus for sports content, Hulu, possibly for more like adult-related content, maybe a lot of those Fox assets coming over to Hulu. And then, of course, you have the Disney branded streaming service launching next year. And that will probably be somewhat of a mixture of everything. It'll probably have some Hulu kind of adult content. We know that it will have Star Wars content, Star Wars shows, some really big budget Star Wars shows, also some really big budget Marvel shows. We know that a lot of talent from their movies, their big budget movie studios, is also going to be featured on those television shows. And they'll probably also have a mixture of like more family related content as well. But when talking about the complete package, Disney CEO has alluded to the fact that they can kind of bundle everything for a discounted price. And that's really a way that you can start to attract a lot of different audiences to their platform. But the reason that all of this is a big deal is because Disney is really transitioning right now. They're really in a transitional phase from being on the losing side of the whole cord cutting battle to now essentially being on the winning side. Now they're going to have all of their streaming services. ESPN Plus is performing very well. Hulu is performing well. And then their Disney branded streaming service is, honestly, it's got to perform really well because it's going to have Star Wars, it's going to have Marvel, it's going to have all their Disney content. I just think that with all of their strong brands and IPs, I think there's no way that Disney branded streaming service doesn't just take off. But that's really long term. I think short term, there are some concerns like decreased revenues because Disney will be canceling a lot of their licensing deals that they have with other platforms like Netflix, for example. We know that at the end of this year, they'll be canceling a lot of their shows and content from Netflix so that they can basically get ready for their own streaming service. But that's kind of just short-term stuff, a decrease in revenue as they transition. And when you think about it long term, Disney won't really have to license a whole lot of outside content to be coming in. Most of Netflix's viewers actually watch licensed content. It's not even original Netflix content. They do watch a significant portion of it, but most of it is licensed content that comes from outside sources. Disney won't really have to do that. They can just reinvest in their own brands, their own IPs, because they just have such a huge backlog, such a huge library that only grew even bigger now that they acquired so many Fox assets. So Disney is a stock that I plan on holding for decades and decades, maybe for the rest of my life. And when looking that far long term, I think Disney will be a force to be reckoned with, and that's why it's my number one largest stock. Okay guys, next up here is Microsoft. Now, obviously a lot of stocks have been doing really bad right now, but Microsoft, another stock that hasn't been doing too bad. In fact, they are up 25% year to date, and they're up over 11% in the last 6 months, despite dropping over 6% in October and now trading for around $106 per share. Now, the interesting thing about Microsoft is that they literally just announced earnings last week and they were amazing. We're going to get into all of it, but they were amazing earnings and the stock actually dropped. If any of you guys were watching it closely, as soon as those earnings came out, the stock took a nosedive and it dropped to under $100 per share, and I couldn't believe it. I was on StockTwits and I was leaving a message on StockTwits, and I was like, the market's drunk. I don't know what it's thinking. These earnings are amazing. And anyway, when it dropped under 100, I hit buy as quickly as I could on my phone. I tried to pick up as many shares as I could at the time and given my budget. But yeah, I definitely tried to pick up more shares of Microsoft because under $100, that price is unreal for the kind of earnings that they announced. But of course, the stock did start to recover a bit after the market kind of sobered up and they put their beers down. The stock just quickly shot back up, I think to around 105 or so, and kind of rallied up to like around 107, around there. Okay, now before we cover their earnings, let's just quickly go over some of the reasons why I'm bullish on the stock. Now, first and foremost, Microsoft is another dividend growth stock for me, just like Disney, and they have a 1.7% yield, very low payout ratio of 36%, double-digit growth rate, and almost a decade of growth. But when looking at their business, they're the second largest cloud services leader worldwide, only behind Amazon, with Microsoft Azure, which by the way is going to be used heavily in the automobile and gaming markets, but we'll talk more about that in just a second. Now, they completely dominate the PC market with the biggest operating platform in Windows. They offer all kinds of business solutions with Office 365. They have tons of services available in the mobile market. They do all kinds of work in artificial intelligence, machine learning, augmented reality, gaming, and despite doing all of that, this is a company that is still expanding with recent acquisitions of LinkedIn and GitHub, which are already seeing very strong numbers. But I mentioned Azure being used in the automobile and gaming markets, so what's going on there? Well, when looking at the automobile market, Microsoft Azure will be used as the base for cloud and connected car services offered by German car maker Volkswagen in over 5 million vehicles per year starting in 2020. By the way, in case you haven't heard of Volkswagen's plans, they've been in the news a lot recently because their CEO basically said that they'll be selling electric vehicles that are comparable to Tesla's offerings for half the price. Now, I have no idea if they will or won't be, but I took a look at some of those VW electric cars and they're not really as attractive as Tesla's, but just the fact that Microsoft is involved, I think, is great news. And to make sure that everything goes smoothly, VW announced that they are opening an automotive cloud development office in Seattle near the headquarters of Microsoft. And when asked for comments on this partnership, VW CEO said this: Volkswagen and Microsoft, with its unique technological expertise, are outstandingly well matched, and together we will play a key role in shaping the future of automobility. Now, when looking at the fast-growing gaming market, Microsoft really dominates PC gaming because they offer Windows, right? Most PC gaming is just done on Windows. And they also are pretty successful with Xbox. It's not nearly as successful as PlayStation, but it does actually perform pretty well in terms of revenue that it brings in. And when looking at the gaming market, you can see on this chart here that it's expected to be worth over $180 billion by 2021, but the segment that will see the most growth is the mobile games segment, which is why Microsoft is trying to tap into it with their newly announced Project X Cloud. Now, Project X Cloud is really a way for you to play Xbox games portably on your smartphone or your tablet, basically using your smartphone's screen as a display for your Xbox games, and then just attaching an Xbox controller to it and playing that way. Now, you might be asking, well, how could a smartphone be powerful enough to run these AAA big budget games? And we're going to talk about Nintendo in a second because they have obviously a portable gaming console that's not really that powerful. And so one of the things that Nintendo struggles with is getting big budget AAA games on their system because the hardware just isn't powerful enough to really run those games. But Microsoft's solution to this problem is by having Xbox hardware consoles, like actual Xbox hardware, being connected to their servers and then streamed out to you, having the game streamed out to your smartphone via Microsoft Azure, via their cloud services with Microsoft Azure. And so that Xbox hardware will basically do all the heavy lifting and then just stream the game out to you, to your cell phone, to your smartphone. So all your smartphone really has to do is just display the video game, and then you can play with your controller. Now that may not be exactly in the mobile gaming segment, but I think it will be at least part of it. And it's a very innovative way of thinking, a very innovative kind of service that they'll be selling. Now, a big concern that people have is they're asking, well, won't it hurt Xbox sales, which are already kind of hurting? And I think the answer to that is that Microsoft doesn't really care about selling Xbox consoles all that much, or at least as much as you might think they do. I think they really care more about selling services. Microsoft is essentially a services company. They really want to sell services, and they want to get you hooked onto their platform, onto their ecosystem of services. And so this is just another way of doing that. And I think it'll be high margin. And when you talk about the buzzword games as a service, it doesn't get more games as a service than this. This is a great way of them selling their gaming services to you and getting you hooked onto their ecosystem and away from something like Sony's PlayStation and things like that. Okay, now when looking at their recent earnings that they just announced, Microsoft reported revenue of $29.1 billion versus $27.9 expected, and it was up 19% year over year. Operating income was at $10 billion, which was up 29%. Net income was reported at $8.8 billion, which was up 34%, and diluted EPS was at $1.14 versus 94 cents expected, and it was also up a massive 36% year over year. And when looking at their different segments, Intelligent Cloud was up 24%, with Azure up an amazing 76%, which I think it was up a little more last quarter, but still, I mean, up 76% is a huge amount. And their commercial cloud revenue brought in $8.5 billion, which was up 47%. Revenue from their productivity and business segment came in at $9.8 billion, which was up 18%, with Office commercial and cloud services up 16%, driven by Office 365 commercial revenue up 35%. Office consumer products and cloud was up 17%. And LinkedIn revenue was up a very impressive 33%. And then when looking at their gaming revenue, it was up 45%, with Xbox software and services up 36%. And even their Surface revenue was up another 17%. And they also returned $6.1 billion to shareholders in the form of dividends and stock buybacks, which was up another 27%. And even looking at guidance, which by the way, we've seen many stocks drop, not because they reported bad earnings, but because they guided lower than what Wall Street was expecting. But Microsoft guided revenue at 31.9 to 32.7 billion. So the midpoint of that being at 32.3, which is slightly higher than what Wall Street was expecting at 32.2. So they guided 32.3 versus 32.2. And it also represents double-digit growth of around 12%. So not only is Microsoft completely on fire, not only have they been making some really great acquisitions, not only are their products and services up massively year over year, but they're also a really good dividend company. And I just think that with these earnings, I think they should have been trading much higher. It's kind of a scary thing to think about because such amazing earnings and the stock hasn't really rallied higher. They're actually down in October. But anyway, I think long term, this is a fantastic company. All right, guys, now last but not least is my third largest stock, Nintendo, ticker symbol NTDOY. Now, as you guys know, I have been cashing in some profits with Nintendo, but because I bought so much of the stock in the past, I think I bought the biggest amounts in the high teens and low 20s, a lot in the 20s for sure. I bought a lot of shares of Nintendo. But anyway, because I bought so many shares in the past, Nintendo is still my third largest stock, even though I've cashed in a lot of profits. But whenever the stock takes a significant dip, that's usually when I try to add a little more. And right now it's starting to look like it might be one of those times because this stock is down 14% year to date. It's down over 25% in the past 6 months, and they're down close to 15% just in October alone, and currently they trade for around $38 per share. Now, having said that, their earnings are right around the corner. In fact, they might even be on the day that I post this video. I think it's on Monday or Tuesday. But I think that if they announce strong earnings, we could maybe see a little bit of a recovery. But if they announce bad earnings or disappointing earnings, then I think this stock could really tank even further, at which point I would definitely try to pick up more shares. So I'm kind of holding some cash on the side in case they do tank even further. But before we get into all that, I'll just quickly remind you why I'm invested in Nintendo. They had really poor performance from one of their gaming consoles that was marketed very badly. That was the Wii U. Their stock tanked, at which point I started picking up a lot of shares of Nintendo. And especially when we started getting news of their newest console, the Nintendo Switch, which is a hybrid console that can be played portably or on your big screen TV. And I found that product to be kind of revolutionary, a very innovative product. And so that was another reason why it just became even more bullish over time. Now that's one reason. The other reason why I've been bullish on Nintendo just kind of historically and especially right now is because of Pokemon. Now, Pokemon is partially owned by Nintendo. I think they own... Dang, I don't remember. I think it was around 30% or so, like about a third of it. But it's also exclusive to their platform. So it's a big deal because it can help them sell their hardware consoles because Pokemon is on it. Now, if you don't know much about Pokemon, it's the highest grossing entertainment media franchise of all time with over $70 billion in revenue. It's probably closer to like 80 billion by now. I mean, they've been on fire. And it's actually higher than Star Wars, which is insane to think about. On top of that, when looking at software sales, Pokemon is the second best-selling game franchise of all time, only behind Mario, which is another Nintendo IP. And Pokemon also has over 7 titles in the top 50 best-selling games of all time. And when looking at the mobile game Pokemon Go, that's already brought in over $2 billion in revenue in just a few years. I think they launched like 2016 or so they've been having huge sales. And they have over 500 million downloads. And when looking at their performance just in September, so just, like a month ago, just in September, they saw revenues increase 89% year over year and downloads increase 100% year over year. So, I think, obviously part of that is because the year prior that game was kind of slowing down a little bit, but it just shows that we're moving with momentum heading into the newest Pokemon game that will be available for the Nintendo Switch, which we'll talk about in a second. But that's really good to have that kind of momentum heading into this newest game is a big deal. Now, speaking of that, their newest Pokemon game will be called Pokemon Let's Go Pikachu and Pokemon Let's Go Eevee. So it's kind of 2 games. You could basically purchase either one or both, I guess, if you wanted to. But which actually, that brings up an interesting point. I think a lot of people might actually double dip and pick up both. But anyway, those games will be launched this upcoming month here in November. So those games will be launched in November. And what Nintendo is really hoping to do is attract their core Pokemon fan base, but also their more kind of general fan base from the mobile game from Pokemon Go. Now that's attracted some criticism because the game has heavy ties with the mobile game, and a lot of the more hardcore Pokemon fans don't really like that. So a lot of them are saying that they're gonna stay away from the game, that they don't want to purchase it because they don't want to support that idea of having a more kind of basic, like easier Pokemon game. But we're also getting a more hardcore version the next year, and honestly, it's Pokemon. It's the first time that Pokemon will be playable on a big screen TV. I really doubt that all these people that are saying that they're not going to buy the game, I really doubt that they're actually not going to buy it. I think they're just saying that, but I think eventually they'll actually buy it because it's the first time Pokemon's available on the big screen TV. Everybody's been begging for that for such a long time. I really don't think a lot of people can ignore that. And then you also have Smash Bros. Ultimate in December, which is already seen very strong pre-order numbers. And then going into next year, like I mentioned, we have a more hardcore version of Pokemon next year. We're also getting Metroid Prime 4. There's also Super Mario Brothers, like Deluxe or something like that in January, I think. So there's a lot of games coming next year. There's also a lot of heavy rumors like Star Fox and some other IPs. So I think next year will also be a pretty strong year in terms of games. Now, one of the biggest things that we have to look out for, and I've mentioned this several times in the past, is the fact that Nintendo has a goal of selling 20 million Switch units for the fiscal year. And if they do not hit that target, I think this stock could really tank. And if they do hit that target, even pass it by who knows by how much, I think the stock could really rally at that point. But the concern here is that they've already reported their first fiscal quarter. That was the previous quarter that we've already had reported. And Switch unit sales came in at only 2 million, which leaves 18 million more units to be sold in just 3 quarters. That's not good. Doesn't leave a whole lot of time to sell a lot of units, especially coming off of only 2 million. Now, the second fiscal quarter is the one that will be reported probably when this video gets posted around that time. And I don't think that the Switch unit sales will be that great in my opinion, because I actually own a Nintendo Switch myself and I haven't seen any good games coming out. It's been kind of a dry spell right now for Nintendo. So I'm expecting unit sales to be kind of low as well. But even if they happen to be higher than the previous quarter, so let's say they're at like 3 million, that would still put it at only around 5 million and leave 15 million more to be sold in just 2 quarters after that. And that's a scary thought. But on the bright side, I think these upcoming next 2 quarters will be absolutely on fire, because when looking at this third fiscal quarter, it's going to be October, November, and December. And we have Mario Party in October, Pokemon in November, and Smash Brothers in December to help drive sales even further. And then when looking at the fourth quarter, that will be January, February, and March, and all those games will already be out by that time. And we're also getting bundle deals for Nintendo Switch units, and bundles for Pokemon, bundles for Smash Brothers. So I think all of that will really drive sales, and I think Pokemon and Smash Brothers alone are gonna be on like everybody's wish list this holiday season. But anyway, my prediction is that they will hit that 20 million mark, but it's gonna take those last 2 quarters to really be on fire. And I think right now in the short term, all eyes will be on this earnings that is gonna be reported right now. And if the numbers are disappointing, I think the stock will tank much further, in which case I am holding some cash on the side just in case the stock tanks. I would love to pick up more shares. But if they announce strong earnings, then this stock could start to recover. So it could be the complete opposite. But we'll just have to wait and see. I'll definitely update you guys on whatever happens. Anyway, I think that just about wraps it up. Thank you so much for watching. I hope you enjoyed the video. If you did, consider hitting the like button and supporting the channel. You can also leave a comment. Let me know how you feel about these stocks, how you feel about stocks that you're invested in. I'd love to hear all about it. I try to read all the comments and respond to as many as I can. But the channel is doing pretty well right now. It's growing. So I want to say thank you for all the support. I really appreciate it. And I hope you all have a great day and be safe out there. I know it's a volatile market. Be cautious. Take your time. Do a lot of research and try to make smart decisions. But anyway, I'll catch you guys later. Have a nice day. Bye-bye.